So if we look at these, now I start with monetarism, and apply this to the bank's crash, the problem of 2007, because from perhaps certainly the late 70s, early 80s, monetarist approach to the macroeconomy was the one that all governments and almost all market economies have taken, with some shades. For example, even though from 1980 to 2007, we've had either Conservative or Labour governments in the United Kingdom, their basic understanding of how the economy works has, for both parties, has been based on monetarist notions. That inflation is caused by increases in the money supply. Unemployment is something that cannot be directly managed by government but has to be indirectly managed simply by markets. So if we applied straightforward monetarist theory to the banking crisis, the argument would be it's a market problem, the market would solve it. So the consequence of this would be something along these lines. Firms and consumers would lose money. Some banks would go bankrupt. People saving in those banks would lose their savings. Firms who had their money in the banks would lose out. Consumers would not be able to get credit to finance purchases. It would become much more difficult to get finance for everything because the bank system had effectively, at least partially, closed down. And of course, firms could not secure investment funds nor finance exports. All of this would lead to a fairly rapid decrease in economic activity and a pretty rapid increase in unemployment. So unemployment would increase. Now, in terms of our diagram, our injections and withdrawals diagrams, this is what happens here. I mean, I've designed these diagrams to make it look as bad as possible, so therefore there is absolutely no investment happening. Basically, the banking system in this diagram has closed down. It may be still taking deposits, saving deposits, but it's essentially not lending money to anybody anymore. The government sector still exists. We're still paying taxes, and government is still spending some money in the economy. Effectively, in this diagram, we've ceased to export because firms cannot finance their exports anymore. In this diagram, we're still importing some goods and services. Now, as I mentioned, the effect of applying a simple monetarist approach to the banking crisis would be a severe recession, eventually followed by recovery. The argument is not that we get a severe recession and we just stay that way, but the economy will recover. We'd have a decrease in economic activity, a large increase in unemployment, but eventually, the banking system would recover. Now, the consequence of this, basically the hands-off approach, is that we'd have a severe recession. Now, if you read newspapers about in 2007 when the banks were having severe problems, if you looked at TV news programs about that time, you will see that, for example, the UK government, the US government, most other governments and market economies were keen not to let this happen. All governments were trying to find out ways of avoiding this severe recession. And in fact, the G20, the largest 20 economies on earth, had a very substantial meeting where government ministers agreed how they would actually try and avoid this. Essentially, what the governments agreed to do, and indeed what governments in the United States and the UK had already started doing, was to prop up the banks. Effectively, give the banks money in order to make sure that they remain liquid, that banks wouldn't actually go bankrupt, banks wouldn't actually close down. Now this sort of notion, interfering in the economy, essentially it's akin to something like attempting to manage demand, which seems to be a return to almost old-fashioned Keynesian macroeconomic theory. There's a question mark in this slide simply because it's very difficult to get certainly government ministers to suggest that this is what they're actually doing. Um, the it's very unclear what their what theory of macroeconomics they believe actually works these days. However, following this sequence, which is what the government essentially has done, is we get these effects. Consumers would have difficulty getting credit. It wouldn't be impossible, it would be more difficult than it is before the crash. Firms also would have difficulty getting credit, with their difficulty finance exports, difficulty getting loans and so on. Unemployment would increase. That's employment goes down, people lose their jobs. The distinctive thing which wouldn't have happened under the monetary approach is government debt increases. Essentially, government gives the banks lots and lots of money, perhaps in return, as in the UK's case, for shareholdings in the banks, and the money supply is expanded. It's what is known in the City of London as quantitative easing. The Bank of England has put more money into the economy in order to try and keep the economy from falling into recession. Now, the last thing, if we're following a practical monetarist approach here, expanding the money supply would have increased inflation very, very quickly. And in practice, that hasn't happened. Now, if we look at this approach again, going back to our diagram, you see the injections and withdrawals diagrams. It's not quite as decimated as it was in the monetarist case. But now we have the difference here is that there's this black arrow going for government directly to banks, which indicates that the government is essentially funding banks. They're funding banks to attempt to maintain investment in productive industry. Government is still spending in the economy. We're attempt to maintain exports. There's probably indeed that export would decrease. The expected consequence of this, and one of the problems we have here, that it's possibly slightly too early to say we're certain this is happening, but the expected consequence of this approach is that the recession would be far milder. The economy would recover faster. And we certainly have had a milder recession than expected. I mean, much milder than, say, in the last big global event, which was the economic depression in the 1920s. It's still too early to say. It looks increasingly likely that we won't have a double dip recession. So, of course, a lot of the things are very similar to following the monetarist theory, but the effects are not severe, I suppose. We get certainly a decrease in economic activity and an increase in unemployment. Again, people lose their jobs. The distinctive difference here is that the public sector shrinks. I mean, it's a given in this case that the banks sort of carry on, but the public sector shrinks. That shrinks because the government now has enormous debts which it has to repay. And one of the ways the government can repay debts is to decrease the amount of government spending, decrease government expenditure on all sorts of goods and services. And that is exactly what the government of the UK has decided to do. By the way, if you're interested in the political arguments about this, the argument between the Labour Party and the coalition of the Conservatives and the Liberals is about the timing of repayments. It's not about the sequence. All the leading political parties agree on what has to be done here.